So you've got this incredible business idea, right? But you know you can't do it all on your own. You need a partner. But how do you actually set that up? What's the right way to structure that relationship legally? Today, we're diving into two really powerful options, the classic partnership and the more modern LLP, specifically looking at them through the lens of Indian business law. Let's figure out which one is the right fit for your dream. It always starts like this, doesn't it? Just a spark, an idea that you know deep down could be huge. You've probably got it all mapped out in your head. You can see exactly what it could become, and you are so ready to make it happen. But then reality kind of sinks in. Being a sole proprietor is tough. The money, the workload, the sheer management of it all, it's a lot for one person. You need cash. You need another perspective, another brain in the room. You need a partner. And right there, choosing how you partner up, that's one of the biggest decisions you'll ever make. Okay, so let's start with the original playbook, the traditional partnership. I mean, this has been the go-to structure for a very, very long time, and for good reason. It's pretty straightforward, and it's all built on a simple agreement between people. Now, this is the official definition from the Indian Partnership Act of 1932. It might seem a little dry, but there's a tiny phrase in there that is everything. See that part that says acting for all? That little detail, well, that's the key to understanding both the biggest advantage and the biggest risk of this setup. So let's break this down. A partnership is based on an agreement, it's got to be for a business, and you all agree to share the profits. Seems simple, right? But then there's this thing called mutual agency. What this means is that any single partner can make a decision or sign a contract that legally binds the entire company and every other partner along with it. So one person's move becomes everybody's responsibility. And that leads us to the single scariest part of this whole model, unlimited liability. This means the business and you are seen as one and the same in the eyes of the law. So if the business gets into debt that it can't pay back, creditors can come after your personal assets. We're talking your house, your car, your savings, everything. It's a massive, massive risk. Now, that exact risk is why something new had to be invented. Enter the Limited Liability Partnership, or LLP. You can really think of it as the evolution of the partnership, one that's designed for the risks of the modern world. You see, that fear of losing everything was holding a lot of people back, so a new law was needed. The LLP Act of 2008 came along and introduced one single feature that completely changed the game for business partners. And there it is, limited liability. This is the whole point. In an LLP, your personal risk is capped. It's limited to the amount of money you actually agreed to put into the business. So if the business goes under, your personal assets are safe. That's a safety net the old partnership model just can't offer. The formal definition says an LLP is a legal entity separate from its partners. That separation is absolutely everything. It means the business itself can own property, it can get sued, it can take on debt, all in its own name, not yours. It's like the business becomes its own person. And being a separate entity comes with other huge perks. For example, an LLP has something called perpetual succession. That's a fancy way of saying the business can keep going even if a partner leaves or, passes away. It creates a much more stable and long-lasting company, although it does mean a bit more paperwork, like having designated partners who are in charge of compliance. Okay, so we've looked at both. Now let's put them head-to-head in a direct showdown. This is where you can really see the differences and figure out which one truly fits what you're trying to build. All right, let's walk through this. First up, legal status. An LLP is its own legal person. A partnership? Not so much. Next, liability, and this is the big one. Your personal stuff is safe in an LLP. It's on the line in a partnership. Now, mutual agency. This one's subtle but so important. In an LLP, a partner's decision binds the company, but it doesn't automatically make the other partners personally responsible. In a classic partnership, it does. You're all in it together, for better or for worse. And finally, registration. An LLP has to be formally registered. A partnership? That can just be a voluntary agreement. Now here's the thing. No matter which of these two paths you choose, there is one document that is absolutely, non-negotiably essential. Let's talk about the partnership deed. Just think of this document as the constitution for your business. It's the written rulebook that lays everything out. Who's putting in how much money, how you're going to split profits and losses, what happens if somebody wants out. This is the document you write now to prevent huge arguments later. So what if you skip it? I mean, you and your partner are friends, right? You trust each other. You'll just figure things out as you go. Well, if you don't write down your own rules, the law steps in and writes them for you. Yep, if you don't have a deed, the Indian Partnership Act has a set of default rules that just automatically apply, and you might not like them. Profits and losses get split 50-50, even if one of you is putting in 90% of the work and capital. Nobody gets a salary, you earn no interest on the money you put in. Basically, you give up all control over the financial setup of your own company. So the message here is really simple. A partnership deed lets you define the terms of your own business relationship and make sure the company runs exactly the way you and your partners agreed it should. It's your business, so they should be your rules. Always, always put them in writing. Which brings us right back to the beginning. You've got the dream, you've found your potential partner, and now you have the information. So what's more important to you? Is it the flexibility and simplicity of a classic partnership, or is it the rock-solid protection and stability that comes with an LLP? The choice you make now is the foundation for everything that comes next. So, which one is it going to be?